next of the supervision of all the constituents of the Indian financial system. So after this, we come to the next topic, which is about the players in the financial markets. Now, specifically, when we talk about the players, then we talk about the participants, say in the primary market, in the secondary market, in the debt market, which we will be seeing in detail in the coming units. But what we'll be discussing here is some of the terms that are used with respect to the participants in financial markets in general sense. क्योंकि जब मैं प्राइमरी मार्केट की बात करूंगी देन आई विल बी टॉकिंग अबाउट द मर्चेंट बैंकर्स, इन्वेस्टमेंट बैंकर्स इन डिटेल, or other intermediaries who play an active role when supporting the issuer firm with the IPO or with the rights issue, private placement, any other route through which they are raising the money in the primary market. When I talk about secondary markets, then there will be other players like the brokers who act as intermediary, and then the primary dealers and all. But in general sense, there are some terms used for people who participate in the activities of the financial markets, and those general terms will be discussed here. First is the investor. So already we have discussed this in the investment paper that we had also. Investor is a person or entity who is investing money with a long-term objective of getting return. So now, again, these sub objectives may be different. Say, I am investing for my further education or for my uh, retirement savings or for the marriage of my children. So I might have a long term objective there, a specific objective, but this is always within a long time horizon. So the time horizon is longer when I talk about investment. On the other hand, again, when I am investing, I am I would say optimizing the risk. So I am not taking um, a number of risk. My investment is more planned, and I am moving with my own money instead of depending on borrowings. On the other hand, speculation or a speculator is having an opposite strategy in the market. They are looking to make quick gains from price changes in the market. So now there is a lot of risk involved. There is a lot of leverage also involved. Leverage in the sense they are borrowing a lot of money. So they are playing in short term horizon. So these points actually make the main difference, as you can see on your screens, between the investors and speculators. Investors are looking at some average risk, but average risk, average return. But speculators are undertaking a lot of risk, and they are expecting a very high return on the money they have put in some asset. Leverage, speculators highly levered, they are borrowing money, investing in the market, whereas investors try to play safe with their own money. So investors, speculators, and next we come to hedgers. Now, if I talk about these terms, hedging, arbitrage, and then speculating, they are mostly used in context with the derivative market, and specifically hedging is more related to the derivative market because it is a strategy through which trader is trying to take an offset position in a stock or commodity to reduce the risk. So, a hedger is Basically, there are number of volatilities, but hedger tries to safeguard himself or herself through minimizing the exposure or minimizing the risk of price fluctuations. So they take up a position that is opposite to the risk they are otherwise exposed to. So if they are holding, say, stock or currency, uh, lump sum currency holding है, and they are expecting okay आगे budget आना है, कुछ fluctuation हो सकती है, so to be on safe side they buy a put option. Put option is right to sell. So now they have the choice of exercising the put option, say 3 months from now, and for that they have paid a small premium. How does this help the person who's holding this currency right now? If there is any fall of currency held by him or her, then they can comfortably sell the currency using the put option in 3 months from today. So obviously I'll not go into much details, but in simple terms you can understand today if I am holding say dollars and the market rate of $1 is around 74 rupees. I'm holding say $10,000 or 20,000 or 1 lakh dollars, typically a bigger quantum because you have bigger players in this market, in the forex market. So a bank is holding 1 lakh dollars and they want to safeguard themselves from any dip in the value or depreciation of dollars in the near future. So they buy a 3 month option. Okay. Now option, and that too a put option, that is the option to sell the dollars at the rate, for simplicity let's keep it 74 only. Now this option, again there are सब categorizations, अमेरिकन ऑप्शन होती है, यूरोपियन ऑप्शन होती है. हम सिंपल केस लेते हैं कि आफ्टर 3 months either this dollar would be selling at 76 rupees or this dollar would be selling at 72 rupees. So option gives the choice of performing the contract. यहाँ पर और इस केस में ऑप्शन कॉन्ट्रैक्ट एक्सरसाइज नहीं होगा क्योंकि मार्केट ही आपको बेटर वैल्यू दे रही है डॉलर्स की. 76 रुपीज पे ट्रेड कर रहे हैं डॉलर्स, सो ऑप्शन कॉन्ट्रैक्ट वोंट बी एक्सरसाइज्ड. But if this is the situation, then through a put option, the hedger has offset the risk. Now, while others will be selling the dollar at 72 rupees, this hedger or this company or this bank will be selling the dollars at 74 rupees. This is hedging. That is safeguarding yourself from the expected price fluctuations. And the fourth player is an arbitrager. Arbitrager is looking for price differentials. They trade simultaneously in two or more markets. Quickly they find places or trades where by uh, buying in one market, selling in the other, they are able to make riskless profits. So they are working or exploiting the price inefficiencies in the market. So BSC, NSC, आपका टीसीएस के शेयर में अगर 50 या 50 पैसा या 1 रुपी या 2 रुपी का डिफरेंशियल दिखा है फॉर फ्यू सेकेंड्स, then arbitrager will capitalize on this, buy in the lower priced market, buy from the lower priced market and sell in the higher priced market. So that is how they capitalize on the price differentials. So this was about